Good afternoon, everybody. It's the Close of Business Gang, and we are back with, I would say, a celebratory homecoming. Amy Jaffe is with us. Those of us in Houston knew Amy when she was here at the Rice Energy Institute, and now she's gone on an adventure. She's up at Tufts at the Fletcher School. She's a research professor and managing director in the Climate Policy Lab. She's written a number of books. She's done a bunch of things since we last saw her. It's really been quite cool. At this point, if you don't know Amy, she's taught energy policy, business, and sustainability at Rice, UC Davis, and Yale. She's affiliated with the Council of Foreign Relations. She does stuff at Davos. She's a world traveler. But more than anything, she's a great friend. Amy, it's so great to have you back. Welcome back to Houston, at least virtually.
I love it. And, Houston is my first home. So barbecue, barbecue, barbecue.
All right, hot dog. Well, here we go. Okay, while Amy's getting ready, and Amy was kind enough, we told her we were going to run through what's happening in the world according to our team, and so we're excited to have Amy in the audience for the run through. Mike Bradley, what would you tell Amy and the rest of us about what's going on the screen right now?
Yeah, Maynard. Hope all's well. I mean, the screen's a pretty mixed bag today. And it's on the back of a really, really strong PPI number, well above consensus at 9.6%. You had a higher than consensus CPI number last week, and you're going to have the Fed meeting on Wednesday. So the markets are simply just grinding sideways right now. But I want to kind of give you a wrap of what's happened here over the last week, and maybe some thoughts as we head into next year. If you look at over here, the S&P, obviously the S&P year-to-date has been a pretty strong, the energy sector has been a pretty strong performer the last 3 months. It's been the best performer. But in the last week, it's kind of underperformed, which you would expect. The second chart would show you is, everybody knows what's going on in Europe, right? Prices are exploding right now for both gas. Gas is up 66% in UK over the last month. We're 90% uplift in electricity generation prices in the UK, and if you look at the balance of Europe, you can see the numbers 75 and 90%. But you see natural gas, it is down 20% over the last month or so in the U.S. because of warmer weather, and it's something that we've had a good call on from Matt Portillo on that, and so that's where we are right now, and it's not going to be resolved anytime soon because it's just a weather call, to be quite honest with you. One of the things that I wanted to talk about is this is a chart, this is really, really important. It's something that everyone is focused on, the markets are focused on, and we need to be focused on as well. And this chart really just shows the, CPI number. I mean, the PPI number in white, purple is a CPI number, and this down here, the blue, is essentially, 10-year bond prices. And as you can tell, they kind of move together, and they really have completely decoupled over here. Over the last year or so, this is something Carl and I have been talking about quite a bit, that the Fed's behind the curve. And I think, this next chart kind of just shows you what's happened here and why this has gotten out of control and why the Fed's responsible and why the U.S. government's responsible. This is essentially the Fed's balance sheet, this wide line over the last couple of years or so, and we've injected roughly $4 or $5 trillion in liquidity into the system. And lo and behold, the red line is CPI. That's fully expected, but the problem here is down the blue line, again, is the 10-year yields, and they haven't budged, a smidge yet. And I think our thought process is that's going up, and it's going to be going up pretty dramatically here over the next year. And so the other thing I wanted to kind of show is, as we're coming on year end, I mean, kind of what's happened over the last 10 years in S&P sectors. And these are all ranked, the S&P sectors, by, from largest to smallest. And what I wanted to point out to you is that, obviously infotech is the biggest sector right now. And back, 10 years ago, it was the biggest sector. But if you look at the biggest sector, 10 years ago, the third biggest, was energy at 12%. It obviously has gone to the eighth biggest sector, it down to 2.7%. So it's really gotten smashed pretty hard over the last, couple of years, 10 years or so. And this kind of slide shows you each of the companies that comprise their individual sector, what's happened over the last 10 years. And you see Apple, obviously, it's a $2.8 trillion market cap. Everyone's been talking about the $3 trillion market cap range this week. But what you can see is 10 years ago was $376 billion. So, that's been essentially a six bagger, and you've seen some other stocks are 8 and 10 baggers. But I'd also point out what you're seeing over here is Exxon. obviously the market cap in the last 10 years has been cut in half. So, and that's what we've seen in the whole energy sector, to be quite honest with you. So, some of the things that I wanted to one of the things I wanted to point out today is I'm really concerned with the Fed is going to have to reverse policy, and what does that mean? And what I did is I took the top 10 market cap stocks in the S&P, and they're all right here. And as you can see, they make up roughly a third of the market cap of the total S&P 500. 10 stocks, and kind of looking at it in other ways, how many stocks in the bottom of the S&P would it take to make up the top 10 stocks in the S&P? It would take up 430 stocks to make up the top 10 stocks in the S&P. And so what that means is a 1% gain in the top 10 is equivalent to a 1% gain in the bottom 90%. So key takeaway is there's a significant amount of risk lurking in only a handful of S&P stocks. So that's something to think about. And the second thing, like we were talking about, is this Fed has basically talked about, inflation being transitory. We obviously have said that is not the case. That's being proven out. The Fed's injected $5 trillion, and what it's led to is obviously these growth stocks, which I think are risky, and a handful of these meme stocks like AMC and GameStop that are really coming in because there's no valuation. I think in that market, with rates going a different way, it's a whole different setup. And even in that setup, I still think energy can outperform because managements are doing the right thing. That doesn't mean the prices can't come under pressure. It means that the companies are totally different than they were 3, 4, 5 years ago, and even 10 years ago. And so I still expect them to outperform. And kind of the last thing I want to kind of give you an idea of, it's kind of interesting is, this whole person, man of the year. 1999, Jeff Bezos was the man of the year, and Amazon's market cap back then was $25 billion. And the reason I wanted to point that out is 2 years later, the company's stock was cut by 90%. Okay, now they're back up here to around, 1.7 trillion. It rebounded quite significantly. The reason I wanted to point that out is this year, Elon Musk has been the person of the year. And all I'm saying is, back here with Jeff Bezos, everyone was hot on that stock, everyone hot on the Amazon, and obviously over the last 10 years, it's done very well. That doesn't mean over the next couple of years it can't really get hit. And so I know Matt Portillo has been really kind of bearish on this name for a while because of the valuation. All I'd say is maybe history is going to repeat itself with this. So just kind of be watching out. And so that's kind of where we are right now. Just some thoughts.
Well, Mike, we were pointing out why when Time Man of the Year calls, I just don't even pick up. It's just a curse. Who needs it? All right. Exactly. Thank you, Mike. That was a great run through. Okay, Matt Portillo, I think we're probably going to go pretty quick. We got the double Matt format here, but Matt, any introduction you want to give Matt Blair?
Yeah, Maynard, it's been fairly quiet over the last week or so with clients. Most, I think, have kind of grossed down into year end. They're just waiting for the beginning of the year to kind of re-engage. We have seen some interesting announcements with return of capital in the upstream space in particular. EQT came out with a buyback yesterday that was well received. We saw Chesapeake add a buyback to its strategy, which was well received. And generally speaking, in the upstream space, what we're starting to see is buybacks becoming an important component of the return of capital strategy. So I think clients have kind of zeroed in on what they'd like to see from a return of capital standpoint. A base common dividend that's competitive with the S&P at kind of a 1.6, 1.7% yield, potentially up to 50% of free cash flow going to a variable dividend, especially for the oily names where there are yield investors that are kind of being attracted to the equities. And then buybacks becoming a bigger part of the program, especially for companies that have good balance sheets and are able to return capital and essentially drive per share growth and accretion by reducing the share count over time. So that's something we'll continue to watch. We do think the gassier names, which haven't really participated in the return of capital conversation, are going to start to enter the mix in the beginning of the next year. And really that's going to round out the entire kind of upstream complex where a lot of cash is coming back to shareholders in the forms of dividends and buybacks. But in terms of actual news flow and where we're seeing real client interest today, I'll turn it over to Matthew Blair. His team has put out some thoughts on the recent RVO announcement and actually hosted a conference call with a large number of buy-side participants this morning. So Matthew, I'll turn it over to you to go through some of the quick takeaways on your end.
Great. Yeah. Thanks, Matt. So yeah, in the world of refining and biofuels, this RVO or renewable volume obligation that came out last week, has just been super topical with investors. A lot of investors are scratching their heads trying to figure out what's going on here. And that's because there were some pretty huge cuts to the biofuel blending obligations, yet RIN prices haven't moved at all. So it's kind of funny. I mean, the Biden administration, they took some hits. The ethanol and corn states weren't too happy with these cuts, but then, there's no impact on gasoline prices because RIN prices really just didn't move. And so we hosted a call today where we relayed some insights from some very smart RIN traders. And I'll just give you a couple of examples of things that we learned and we'll pass along to clients. So one, we learned that D4, which corresponds to biodiesel and renewable diesel RIN generation, that the data that comes through from the EPA is actually overstated. And it gets a little arcane and complex, but basically what happens is biodiesel producers, so they'll start out, they'll blend, or they'll produce a product that's 100% biodiesel, and then they'll splash blend 1% petroleum diesel into that product to create a B99 product. And they do that to capture a $1 per gallon blender's tax credit, which is also called the BTC. And then if they turn around and they export this B99 product, they still get to keep that BTC. But when they export that product, those RINs associated when the blending occurred are effectively retired. And so refiners like Valero cannot buy those RINs. And so the EPA is showing basically D4 RIN generation data that is too high. And so, for everybody trying to create a RIN supply demand model like we are, we basically need to make a key adjustment to get to better data. So that's one example. The other example that we learned from these RIN traders that's really affecting pricing is that the trading community is very concerned on feedstock availability with biofuels. And so if we're actually able to find some data that showed this year that for every 3 new gallons of renewable diesel that have entered the market, we've actually lost 2 gallons of biodiesel. And so when the RIN traders see this data, they definitely have concerns on, hey, is there going to be enough animal fats? Is there going to be enough vegetable oils to really feed all these new renewable diesel plants? And so, just looking at the schedule, I think there were 4 very large RD plants that started up in 2021. I think there's at least 8 scheduled for 2022. And so when RIN traders see that list of new projects, they actually don't think there's going to be that many more incremental D4 RINs generated because you're simply going to replace existing biodiesel production. And so that's another adjustment that we have to make in our supply demand model. So I think it's with some of these insights that we've been able to help our clients, our investors understand, hey, this is what's going on in the RIN markets. These are some nuances that you need to take into consideration. And this is why RIN prices are still pretty high, despite some of the big cuts that have come through.
Well, that sounds like real high value added, Matthew, because that stuff sounds pretty darn complicated. Thanks for doing that, and thanks for sharing that with us. Colin, we're last up on the way to Amy. What would you tell us? What's on your mind?
Well, I know we all want to get to Amy, so I'm just going to give 3 prices that have really caught our attention. Today in Europe, European gas prices in the prompt months are trading on either side of $43 per MMBTU, a little bit higher in the Netherlands, a little bit lower in the UK, and that's even at a premium to what we're seeing in the Japan-Korea marker for LNG. So prices far above what we're seeing in the United States. The second price is on December 8th, just about a week ago. In the European emissions allowance market, we crossed $100 per metric ton for the first time across each of the December contracts out through 25. Look at where prices are today, trading in the $90 to $95 per ton range. And then picking up on a point that Mike made, the Fed is clearly behind the curve, but markets are starting to catch up. And the 2-year in U.S. Treasuries has increased by 45 basis points on yield, looking at the past 3 months. So even though the 5 and 10 years are not yet building in the kind of inflation expectations that one might surmise, we're definitely seeing it at the front end of the curve.
Well, I'm not a Fed historian, but I do tend to recall we had a series of rate hikes towards the end of the first tech boom when Amazon was going from 25 to 4, there was a lot of rate hikes in there, which adjusted the valuations of those stocks. There were other things going on too, but Colin, is that a historical analogy worth making?
Yeah, I think the 90s are a good analogy. People are tempted to make analogies with the 70s. I was in a grocery store earlier this week and I saw People magazine is like parting out, old, covers from the 1970s because of inflation and all the rest of it. 1994, I think, is the strongest parallel. You were in the early stages of an economic expansion. The Fed got behind the curve at that time, too, because the oil price spike following the Persian Gulf War was going to be transitory. And suddenly they had to play catch up in June of 1994. And even those 50, 100 basis point moves in the first part of that process really caught people off guard. And there is some risk here that people are too focused on a sequence that goes from tapering into rate hikes, and that the Fed surprises us with a number that's a little bit bigger on the hike side than people anticipate.
Well, and Colin, I'd be remiss if I didn't wish you, on behalf of the entire Close of Business team, a very happy birthday. You had a birthday this week.
I appreciate it. Thank you very much.
All right. Amy, this is so great to have you. I rattled through a number of the things that you've been doing, which is really, you're an ambassador for us to this huge world out there of policy and academia and, just the global thinking. As we jump into all this, what's been on your mind lately? Are you just kind of walking around feeling dizzy like the rest of us, that this transition has become so many moving pieces you can't keep up? Just maybe that's a lead in. How are you feeling about the world as you watch all this stuff?
Well, I definitely have attention deficit disorder where I'm having to jump from topic to topic. And, hearkening to Colin's point, I had a piece today. I'll have a piece Thursday. Today it went online. Thursday it's in the print version in the Wall Street Journal about the jillions of dollars that are going into climate solutions or climate risk adjusted things, whether that's ETFs, indexes, ESG. All our friends from private equity have pivoted away from the shale and they've pivoted to green funds with renewable energy companies. You've got the SPACs business, which over 36 SPACs, picking up EV charging and battery trucks and, so forth. So when you put that whole picture together, when I was researching it, I came up with a statistic that kind of shocked me, which is that, I don't know if you know the term crowded. So that's when you have too big a preponderance of market sentiment is focused on one trend line, like your discussion about the top 10 companies in the S&P. Well, turns out the push into climate solutions investing is of the same measurement as the dot-com boom at its height. So I'm not saying it's going to pop. It's, as a theme, we can kind of see the green stimulus in Europe and in the US, and we can see, the Glasgow outcome, which focused on net zero. So, 2 degrees in Paris is long gone now. Now we're talking about net zero and 1.5 degrees, and everybody's having to pivot to that. But it does sort of speak to the fact that there are a lot of things frothy in the market. And as you know, you mentioned my books, my book about the 2009, financial crisis, I think is always repetitively instructive, especially when it comes to the energy complex. So I do see some, headwinds ahead. And I, again, riffing off of some of the things you've been discussing, one of the interesting things about these top 10 companies, which I think the Houston community might know in the back of their minds, but maybe it's like not in kind of their conscious face. I don't know if people understand that, like Amazon just announced that they have some under $50 automated smart thermostat you can buy and stick in your house, and then coordinate with, Alexa or whatever your voice command system is. And that was on top of Google Nest Renew, which is Google's thermometer that will actually AI automate you to use more electricity at noon when it's very in the duck curve, height of the duck curve, or at night when it's windy in Texas. And Tesla, let's talk about it. Tesla is coming to retail electricity in Texas. So you tell me, those companies which now control, not only the top 10% of the stock market, but 90% of our lives, are coming into the energy business big time.
It's a great point, and I'm sure I want to highlight Amy has recently written a book, Energy's Digital Future, Harnessing Innovation for American Resilience and National Security. And I got to believe that some of these themes are showing up in there, Amy. Could I ask you one question that I think we just all find interesting? So you've been at Rice, you were at UC Davis, now you're at Tufts. When you have a energy conversation at Tufts, if you had a luncheon and said, hey, what's everybody thinking, feeling? Like, we don't know what that environment is like. I'm just kind of curious, what's on the minds of your students? And are you feeling people wanting to go into energy? Is everybody want to go green? Because it seems like the talent, much like the capital, is all piling into one area as well. But what would you tell us about your community there at Tufts?
Well, I will tell you, I have, students actually from all around the world, because Fletcher School is a pretty global school. So, some of the other international programs, as you know, I work closely with the Columbia crew and so forth. But a lot of the schools have Americans that want to go into international relations or want to be in international business. But Fletcher School really focuses on, it's a very global community. We have American students, but we have students from Africa. We have students from India. We have students from Latin America. And so it's very global. And indeed, regardless of the country, there is this proclivity to want to focus on the energy transition. And you have some students that really want to understand what is the pathway their country is going to face. Are they going to be able to retire coal? What would that mean for the average person in India? India, the percentage actually, ironically, of coal workers in the United States is unbelievably small. Not for oil and gas, but for coal, right? Whereas in India, it's a giant portion of the workforce in that country. And so you have this sort of dual concern where you understand about the impacts of climate change, but you're also thinking about sort of the just energy transition. It's a big topic at Tufts is, how to make an energy transition in a way that includes all people, doesn't disadvantage particular communities, and where everybody is participating in a positive way. We have another, catch term for that, green industrialization. So we want to be able to provide a living, a respectable living and movement into development in countries, but in a way that has more decarbonized pathways than we've seen in the past, which was a very, steel and cement road to development like we've seen in China. So, I think that's really the focus. And I would say my students at Tufts, which I think were very much similar to my students at Rice, are very realistic. So, we did our final presentations today in class, and there was one group that presented about solutions to the duck curve. And so, giving it some thought. And when we did our, in my class, we do a simulation. Well, we do one simulation where everybody pretends they're a minister of OPEC. I've been doing that for years, but we have a new simulation where we have I assign two people in the class on different days to be president of the United States. And then they have to hold a cabinet meeting. And in the middle of their cabinet meeting, I create an energy crisis and they have to respond. And so this year, we had this multifold energy crisis, and it was pretty easy because we're, having these crazy energy crises localized, in many different places, China, Europe, whatever. And I will tell you, it caused the class because the young man playing Secretary of Defense in one of the White Houses was European, and he could not get the president to focus on the troops on the Ukraine border. And that upset him as a person, not just in the simulation. And so the class wound up having a off-book 20-minute discussion about whether or not President Biden should fast-track green lighting 2 new LNG facilities in the Gulf Coast. And this was, yeah. And we had a really, spirited discussion about, short-term versus long-term in terms of forging energy policy and dealing with, the geopolitics of today versus this long-term plan towards this, just and green energy transition over time.
That was fascinating. Maybe someday we just do that virtually, and we have students all over the country, and we get all schools, and they can participate, and then we'll show the highlights or something. But that was quite cool. I was just wondering a question. As we were going through the data, and Matthew Blair was talking about the various imperfections in the data, and Mike's talking about the prices and the market caps, and Colin is doing similar things. What's your experience? So many policy leaders, regulators, heads of multinationals, and heads of NGOs and things like that. Do they just find that data dizzying and it's just short-term noise, or do they find that data really informative? Because that data seems to be pointing to a lot of real issues in the short term. And I'm just curious, do you have a view on how connected the policy world is to market data? Do they need to be more connected? I'm just curious, because it's a dizzying amount of stuff. You could see kind of trying to ignore it, but at the same time, it's showing you problems before they happen sometimes.
So this is how I would say it to make you feel a little bit better. So I find that when you're really talking to people seriously about policy, everything's data today. We have all these tools now with data visualization, so that, it's pretty hard to ignore the data because we can make it so clear. I was just up on the Hill testifying in front of one of the select committees. And, you put something up that's got a map with the, data, the bubble data, or you're doing something that's got price data, it's pretty compelling. So I think where the disconnect comes is you've got all these people who really are, I think, looking at policy and looking hard at the data. And, same thing, in commodity markets, the hedge funds are like data consumers to the nth degree. But then on the flip side, our political leaders, when they come out to talk to the public, it's as if data doesn't exist. Then it's all just, touchy-feely. I'm going to say something to you that is completely disconnected from the data that's going to give you a good emotional feeling or get you revved up or make you angry. So you'll, side with me. And then we move totally away from the data. So in the public square, I find my job where it's not just to educate young people, but also to educate the public about the complex things that move the market or affect our energy choices. It's impossible because there's so much noise that is disconnected from the data.
No, you're totally right. I mean, this has been a little bit of our mission here is just to try to get people to talk to the data. Now, to be fair, most of our audience are energy people, so they're aware, but still, even on this question, Maynard, maybe I'll lose some friends here, but even on this question, as you know, you and I and your team, Colin and I, we've been talking about the oil price cycle for how long? I mean, I'm not even going to say how long in my case, because I'm older than you folks, and I don't want to give that away. So the point is,
my birthday was just this week, and I just turned 22, so it could have been that.
Yeah,
long.
there you go. Okay, well then I am younger than you. So point is, and here's really the point: we know a lot about the cycle, and we know that in 2020 we had this unbelievable anomaly where demand created, and in my opinion, because I've seen what I think is the real data, I think demand created much farther down than the OPEC team and some of these other people who like to put, disinformation into the data market. I mean, it collapsed big time. And we're talking, down 30 million barrels a day at one point, or 40 million barrels a day at one point, globally, briefly, but, to a really extreme. And then, now suddenly we had this situation this year where the U.S. economy at one point was growing at 6%. I mean, I can't remember the last time the U.S. economy grew in any period at 6%. Now, that's kind of like a, China, Vietnam type number. So, so the point is, when you have that kind of collapse in demand and collapse in prices, people stopped drilling. I mean, part of the reason people stopped drilling was that they had containment problems. There was no place to put the oil. And we're, and now we have, is it capital discipline, or is it just that people stopped drilling and now they got to reevaluate how they feel about their, 2022 program or their, longer range plans. But then we had this sudden, reemergence of demand, which is not dissimilar to the 2006 to 2009 period, where you had this giant demand shock coming out of China with the Olympics and so forth. And not that different than a few years ago, where you also had kind of a demand-driven rally. So it just happened in an unbelievably compressed period of time. And I'd like to tell my students that we're really gung-ho. The energy transition is deep underway, and it might be in some investors' minds, so it's harder to access capital markets. And the risk for something that's a long duration, mega project in an oil or gas field might look pretty unattractive to an investor today. But we haven't hit that point yet. We're still, in my opinion, dealing in the market with the fact that the energy market was so disrupted in such an unprecedented way in 2020 that the adjustment period of having demand swing back in 2021 is almost impossible to respond to, even if things were normal and there was no energy transition.
One of the things, Amy, I think that is quite common in oil and gas circles is if you look at what the world is seemingly doing, like we're not permitting infrastructure. We're making it harder to get a permit. We're making it harder to get capital. We're making, various government agencies, more and more people are into the, making oil and gas life harder. Big companies are reducing their spending, changing their strategies. Almost everywhere you look, people are pulling capital out of the oil and gas world, particularly the oil world. And if you just examine it as a policymaker, it looks like we're just determined, we're just headed towards an oil shortage or spike, or it just looks like, how can this not be where we're headed? But do you have
let me push back on that a little bit. You know me, I'm always a little bit of a bear,
We need to.
I came into the business when we were in the collapse in the 80s, and it's like colored my view. So my point to you is that actually, I was at a presentation, academic presentation, and there were people, the Dallas Fed's done some interesting work, and there's some other economists that have done some interesting work. And actually, the price that a independent or even the majors have to pay to enter the bond market today is completely unchanged. So you don't have to pay a premium. The capital in the bond market's readily available for oil and gas. So it's true. Okay. Right. So it's true if you wanted to borrow money from a bank, given all the things that have come to pass in the last decade, maybe that'd be a little tougher. And you have some banks that are under pressure to move away. But, it's not like the U.S. government was lending to the oil and gas industry. And actually, the Biden administration has basically followed through with leasing. So, I'm not even sure that's correct. So people point to like Keystone Pipeline. And to that, I say, really, truly, on what planet would you realistically look at what the Saudis are planning in terms of increasing their capacity, look at Abu Dhabi's increased capacity plans and their plans to enhance their flexibility for their positioning in the market, and look at, other things happening, out where it's low cost production, would it actually make sense to invest in new greenfield $90 to $110 oil in Canada and the infrastructure that would go with it? I don't think that makes sense. Especially because the Biden administration is putting a lot of effort. They just announced their EV battery industry, rollout plan. That's billions of dollars to go into that sector. So, is it that there's a conspiracy with the banks and finance, or is it really just that, if your company's doing well, you can still access the bond market, but if you wanted to borrow money to invest in, oil sands or a pipeline that goes with oil sands, no one wants to take that risk on, and maybe justifiably so.
Well, it's fascinating. There's certainly the equity market. There's not capital to do oil and gas, and that certainly has a lot to do with people's fear about what the world looks like. I'm just asking from a planning standpoint, if we have $100 oil in 2025, that's not a good thing, or even more. It just seems like, how can we, I don't know, that's what we're all a little fearful of, because honestly, even though oil and gas companies make more, if you have a disrupted market, they'll probably get blamed, and it'll cause a lot more problems than it might be worth.
I think that there is this challenge in the policy world. If you accept we're going to have a transition, and maybe the transition is not going to be at the pace or the size or the scale that any particular party wants for a particular year, depending on their point of view, where they sit in the transition. Is it their job that's going to be affected, or is it their family that lives somewhere that's having a heat wave and people are dying? It's kind of like colors your perspective. But, putting that aside, in the end, part of the problem is there's no centralized authority. So, how do I marry the scale up of things that might remove demand with the scale down of supply? And how do you match those things in a market? And I think investors are struggling. They're struggling to decide where should they put their money, and return is a feature. So again, I don't want to pick on anybody, but so maybe I won't name companies, but there are companies that have a 10-year track record of destroying capital. And that's the track record. And I was sitting one time on a panel. It was myself, Kevin Book, and a chief investment officer of a giant U.S. pension fund. And, Kevin was defending Maynard. He's saying exactly what you're saying. There's going to be this big rally in oil and gas, and, it's nothing to abandon yet, because there's still, where it's talking about, decadal transformation, and still money to be made in oil and gas. And he's making his pitch deck. And the CIO turned to him and he said, listen, I get limited capital. I got to make a pick. If I have to choose between, and he said the name of a giant oil and gas entity, or Apple stock, why would I pick the giant oil and gas company? Why wouldn't I just pick Apple? And, it took us the whole discussion in a very different direction. And, maybe people accused him of making a false choice, but, you showed the charts, right? I mean, if I was going to make this giant return on Amazon, and then Amazon told you that they're going into your electricity market, and Tesla's going into your electricity market, and they're going to let you pick the electricity you want, right? You're going to be able to pick the time of day you do things. And they're going to give you the data, talking about data, they're going to give you a readout every day if you want it, or once a month if you want it, that's going to tell you what electricity you bought at what price and at what time of day. And then you're going to be able to, you or yourself control whether you adjust what you do or not. And they're going to let you adjust that daily. That's if I'm buying that stock versus some stock where a guy's trying to convince me that, poor people in Africa that haven't had access to oil and gas for the last 50 years are going to suddenly have access to it now. Like, why? Those are my two choices as to which one I want to buy, which stock I want to hold. Alexa, beam me up some electricity. I'm going to go with the tech company.
Well, and that's, I feel like I think what we're trying to understand is it looks like we're steering towards a future of higher oil and gas prices coming from less environmentally friendly places. And that doesn't look like, I think that's the question. But Colin, I'm going
to, one more point, Maynard. Saudi Arabia and Abu Dhabi and are spending the money to decarbonize their energy production and to capture all their methane. So with all due respect to Texas, you get other countries that are these so-called players. They have better environmental practice right now. So, the U.S. has a competition to catch in that regard.
We're spending. What about those Russian guys? I studied their language in college.
Maybe I got to tell you, every time you say ALEXA, my ALEXA keeps turning on. So she's got some strong views. She's on making music recommendations. I've turned mute on at least 3 times. It might be helpful, maybe like on behalf of industry, just to kind of get your response. If I could, kind of repeat what I think industry would say in response.
I'd love to hear it. Absolutely. 100%. Let's do it.
I think on the investment thing, I think the first thing they point out is the World Bank actually has ceased all investment in oil and gas. So if you're in Egypt, it's just not true that you still have access to the same capital you did before. In fact,
I was just talking in the U.S. You're right. That's 100%.
Yeah, but it's a global market. So I think the first pushback would be, Egypt. I
agree.
Can't source that anymore. That's point one. And then, even in the developed countries, when we look at the super majors, the target returns are 4, 5, 6% in solar. So you have investors saying, well, wait a minute, it may be true that E&P companies destroyed capital for the past 10 years, but a 4 to 6% target nominal return, when I have Mike's PPI number close to double digits and CPI at 6 months, I'm losing money. So that's just totally unacceptable. I can't do that.
Listen, I was inside, as some of your listeners know, I had a strange experience in California. I won't, overshare that, but because the University of California is a giant morass of politics, I wound up as the sustainability officer, advisor / whatever you want to call me. I guess my title was, I don't remember now. Anyway, point is, they put me in the pension office at the UC. And I can tell you, people brought us ventures with an IRR in renewables of 7 to 12%. And we invested in those and we had good return with it. Right. So the numbers let me just say.
But Amy, those are historic numbers. What we're saying is you gave the example of the investors presented with 2 choices, Amazon and an oil choice. Today, the promise is 4 to 6%. Now, obviously, it could be lower, it could be higher. But if you're running that public, pension fund, you've got to take seriously that you're being promised a certain number. But if I could just make a couple other points, because I think I can hear our audience saying, "But Colin, you make this other point." On the demand in the emerging world, LPG demand in India just passed 1 million barrels per day in the past month, and the answer is the Indian government has this as one of their major demand development program. So it's heavily subsidized. It's a deliberate, program there. And I think that's important to acknowledge. On I was interested by your class. The Tufts Group wants to, permit subtly on a fast track basis those 2 LNG plants We just had the senior senator from Massachusetts say the exact opposite thing and elicit a response from a CEO of the nation's largest natural gas producer. So that's kind of an interesting context. And then finally, well, I guess two more points. When you look at the Keystone XL, 800,000 barrels per day. I mean, I think it's a tough nut to say that that didn't have an effect on, forward expectations. I'm looking here on the CL60 price on my Bloomberg screen. Clearly, markets discount the future. So if you take away an 800,000 barrel per day local pipeline and you have to build in the transportation costs.
Hey, guys, you know that other pipelines have been built in the interim. And you also know that, a lot of the Canadian companies went under, the majors have all pulled out of there. I just think the prospects.
No, my point's much simpler. That if the oil is coming from Alberta into Pad 2, that's a cheaper transportation cost than coming from the Middle East into the Gulf Coast. It just is.
But some of that oil is coming anyway. It's just coming on different pipe because we didn't build Keystone. And if I think in the end, somebody did the Keystone guys a favor because what was going to happen is they were going to build a pipeline for 800,000 barrels a day and the oil was not going to show up. Right. And we've seen that. We've seen that in the industry before. I'm not saying that we don't need oil from someplace, or I'm not saying what demand's going to be next year or the year after. I'm just telling you the long-term trajectory for that oil at $110 a barrel was not going to be profitable.
So one last point, and that is on this question of a politician talking about demand. I think, I can hear the audience kind of saying, we just saw the SPR get tapped for 50 million barrels, and a reporter asked the Secretary of Energy, what's the level of demand? And she didn't know. And, that is problematic. If an investor is watching that and the person who's in charge of the department that produces the statistics and is in charge of the process to release the barrels can't answer that question, there's a serious problem.
Well, listen, like I said, got to work from the data. There are things that people from the industry say that are also, they might not be able to answer that question. I think the real thing we should be talking about is what are the companies that are forward-looking thinking of doing? So you mentioned EQT, right? You mentioned, I think if I remember recalling, people are talking about EQTs buying back some of their stock and people are kind of liking that play. Well, here's a company that, and the group that's a main shareholding in it, that's fundamentally looking at interesting things. It's a company that's committed to hasten reduction of methane leakage. It's a company that new wells have no leakage, or to speak of, not the same way that we're seeing in other parts of the industry. It's a company that created a SPAC. Well, not the company, but the Rice family, created a SPAC to look at renewables, renewable natural gas, and they're looking at carbon sequestration. You've got companies like that from different parts of the Midwest that are in gas or in midstream that are looking at hydrogen blending. Dominion has, that interesting project in Utah. So, people are doing interesting things, and no one's going from 0 to 60 because it's not necessary yet. But if you're doing nothing, and I'm an investor, I'm a little concerned.
I think the report, Amy, we share, you travel oil and gas country as much as anybody, is we agree EQT is doing some phenomenal things. But there are lots and lots of these U.S. players doing really great stuff. If you look at Phillips 66, their ESG report, if you look at Liberty's ESG report, there's a lot of great ones, a lot of neat stuff happening. I think what we're concerned about in energy country is just that when we're doing so much surgery so fast, and there is an anti-energy company attitude in Washington, D.C., and you do have the Secretary of Energy who doesn't know the daily demand for oil, seemingly. It's just alarming where we're headed. But let me ask you another question. Natural gas. This seems to be everybody, what is natural gas going to join the community of it's good, it's helping, or is it going to stay? Are the voices who say it's a fossil fuel, keep it over there, are those voices going to win? How do you see the natural gas debate playing out?
Now, did you see my op-ed in the Houston Chronicle on this subject?
I haven't. I'm remiss.
Yeah, so go Google for it. I mean, but the headline is natural gas is having identity crisis. And to me, it's the industry's the win or lose. So you have these two trends in the natural gas industry. I'm either going full-fledged to defend my right to have a dirty fuel, or I'm wanting to talk about natural gas's positive qualities, and therefore I'm killing myself to make sure I'm not only cleaning it up, but making it a attractive product. And, I think you have a divided industry on what approach one takes. And even among, the groups that do communications for the industry, there's this identity crisis about, are we defending jobs and our right to pollute? Or are we thinking about how to make our product part of the solution? And I think there's a lot of really good work taking place. I mean, I just did some work where I surveyed 20 plus companies in the midstream about how they're seeing the future and whether they are or aren't interested in hydrogen as a business, or are they going to stay, with the molecules they're doing. And I'm hearing a lot of CEOs and strategic leaders and technical people thinking about their role as a gaseous company and then trying to figure out what gas it is going to be the profitable gas to sell and transport. And the question is, am I going to just try to stop there being an energy transition? Because it's not about, is my fuel a good fuel, a bad fuel? I think really the way people in Houston want to be thinking about this is, what's my role as a company in the energy transition? I mean, somebody showed me a billboard from the World Petroleum Congress that said, Houston, home of the energy transition. They threw the word transition off of the, after the energy thing. And I think it was, I won't say, but I think it was an advertisement by Hess. So my point is, I think the companies themselves, I hear it. I could list the chairman for you. There are some companies that are out there that are really thinking about what is their product, who are their customers, and what is the product for now and what's the product for the future, and how do they get with their customers to talk about what needs to be done to get there. And is that, in the case of one company that had a customer on the end of their line that wanted to put 30% hydrogen to meet their own corporate ESG goals, and then that company had to face the fact that one of their compressing stations wasn't up to snuff, and they had to decide, should they make that investment, not make that investment, to facilitate getting to 30% blend in a part of the pipeline. But we have a lot of infrastructure that could be retooled, and we have a lot of knowledge and personnel that could be forward-looking. And, quite honestly, and I said this at the end of my article in the Journal, with all due respect, Saudi Aramco is a leading firm. Saudi Aramco has already made billions of dollars of commitments to do ammonia and to do hydrogen as a future fuel. So if you're an American company, and America could be a premier hydrogen player because we get more hydrogen infrastructure probably than any other country in the world. I mean, if Saudi Arabia, with their, tiny cost oil, is thinking that they'd like to pivot some of their resources into blue and green hydrogen, then why would the industry in Houston not look at the same picture and make the same decisions? I
guess what I'd say, and I really mean the same, because we've been in boardrooms and with management teams for the last, since we started the firm. And I don't know a single U.S. company of any size that isn't taking all of this really, really seriously. Like super seriously. Like,
no,
so
I
many
agree.
people like dominating every board discussion. And I think Saudi Aramco, some of those companies, is not taken away from what they're doing, but I think that the industry, I think it's got to work on its profitability, which it's been doing. It's been working hard on its ESG record, but we got to get the rest of the world to take another look at what U.S. energy is doing, because it's really impressive, is our feel. And I think the energy transition, I think we do get really excited about when you visit with these companies, because they're so entrepreneurial, right? They did the shale revolution. They're so entrepreneurial. They're so talented. We're pretty convinced they are going to play a pretty big role. But we got to fight through this, exactly what you're trying to do. We got to fight through all this energy misunderstanding that's out there.
No, I agree. And there's a lot of either wishful thinking or just misunderstanding about, timescales and assets. So, and also you're just going to have a different competitive landscape. Someone who was putting in midstream facilities 10 years ago, they did not have to think about whether Form Energy is going to hit with this iron air battery and how many stacked of those batteries might mean you don't need a peaking plant. I mean, and if that happened, is that 5 years from now? Is that 10 years from now? If you're building a new asset, is it just geographic or locational? I mean, there's a lot more risk today. And the other thing I would say about the industry, which is varies, from company to company, is one of the things I think that gives like a Tesla or an Amazon or an Apple an upper hand is that they're companies that have previously done product development and therefore market development for a product. In other words, they've come up with a new product. They've tried to think about how to develop markets for that product, right? Whereas a lot of the oil and gas management are trained either in logistics or honestly, they're just trained in financial engineering around rent seeking. And so
they're not retail companies. We notice
correct.
this all the time. They don't deal with customer. Right. They don't deal with the walk-in
the customer. But in the future world where we're talking about innovation, even the innovation of shale, right? When we're talking about innovation, we're talking really about product development. It's not just how do I move molecule fuel A to molecule fuel B, right? It's really about what kind of products and services are going to surround that fuel, whether it's a mobility service or, my smart thermostat or a resiliency service, right? I mean, people are looking for different things in different settings. And there's like a product development aspect to it. It's like, I don't want just the fuel. I want the use equipment that goes with it, or I want to think about how the backup system for that's going to function if I have a weather event. And it just takes more differentiation. I want to think about its performance as a fuel from the point of view of air quality, or its point of view from the point of view of environmental performance. So I think in a world where my gaseous product or my liquid product is also going to compete with an electrical product, and cost is going to matter, of course. But, this is, I have this speech I used to give to the industry. I'll end with this. I know. So here's my smartphone, and it costs a lot more than my analog phone ever cost me. And the data package that goes with it is ginormous compared to what my phone bill was like when I was a college student, which seemed high to me at the time. And yet I tolerate it. Why? Because it's a superior technology. This thing can do a lot more than what the analog phone, all I could do was, call my mother and have a conversation, either positive or negative, depending on whether she liked or didn't like what I was doing. Right. Whereas with this thing, I can send her a video of myself doing something with the dog. Like it's endless, the things I can do with this device. So my point to you is that that the energy industry now is really transforming, and it's transforming not only in what fuels we're going to use. It's much bigger than that. It's the products that are going to use those fuels and how they're going to use those fuels and what the customer's expectations are going to be and what price will be accepted in the market. And I think that the challenge of doing product differentiation and the challenge of having a truly competitive market with multiple different kind of fuel sources and multiple different kind of backup systems is much harder and more complex.
Yeah, and it's probably the most interesting is division, if you will, between the customers. Just like your grad school, your class, 2 billion of the customers have certain needs and certain incomes and certain desires, and 6 billion have some other needs and other desires, and so all customers globally are not the same. But I got to do two things. One, I got to thank you, Amy, because you're helping us do what we really, really want to do, which is to engage around these issues and try to make sure there's a great, robust, and honest and friendly debate. So God bless you. We needed to hear from you today, so thank you. And my second question is, well, it's a two-parter.
Okay. One,
can we get one of your one of those Fletcher interns to you tell them that Close of Business would love to have one anytime somebody wants to spend a little time.
I'm going to have a line. I mean, there'll be a line if you guys want to have an intern. I got an intern.
We want them. And the last question is, what can we do for you? We appreciate you coming on. What can we do for you?
Oh, listen, your friendship's what means a lot to me, and I just love to hear your updates. Maybe put me on. If you got something you email out to your clients and you're willing to send it to me, I would read it every day.
You got it. Careful what you ask for.
No, I love reading that stuff. I've always enjoyed your emails, and then I move around, so I lost my newsletter access. So I'd love to have I don't know what you're emailing to your customers, but I'm sure there's something you're doing that's giving people a sense of the market. Love to see that.
Well, we're giving it the college try, or I should say the grad school try with you. Well, Amy, thank you for joining us. We really appreciate it. Come see us when you're in Houston.
I will do it soon, I'm sure.
All right. Bye, everybody.